All right. Thanks so much, Rich. And thanks so much, Dan. I always appreciate the opportunity to be here and visit with folks. And typically, yeah, what I'm doing is talking about pre-harvest marketing plans. But obviously, we're moving into that post-harvest side on the wheat now. And I kind of try to report on plan progress. So that's basically, I want to do two things. One, we'll review the results of our 2023 wheat, feed grain, soybean pre-harvest marketing plans. Where are we at? What were some of the decisions? At the end of that, I want to touch on each of those, kind of try to break out, because one of the things we do in our workshops is we talk about, well, you might use forward contracts, you might use futures, you might use options. What tool you use obviously impacts how things turn out. Now, at the end of the day, it's the timing. A lot of these things, yes, basis can fluctuate, futures will change, but that timing and when did you, price that product, whether I use a forward contract or whether I use futures, a lot of times are going to end up very similarly. But as we show today, you might be feeling very, very different based on some of the tools you use. So we'll talk about that a little bit. And then the last thing I want to just ask a question: should we start looking at our 2024 pre-harvest wheat marketing plan? And spoiler alert, the answer is yes, we should be. So with no further ado, just take a look here at the corn side. This is our kind of our feed grain plan, largely corn. We always work off of December corn futures. I just want to kind of go back and you look at that chart. We started January 1 and December corn was at 607. And so one of the things we try to do with our marketing plans is we look at the seasonals, and we try to set pricing targets with the idea that as prices would go up from the 607 level, we'll try to price into those rises. But if prices don't, which this chart largely reflects, we see things going sideways, we also like to have date targets. And as you look at this, we priced 20% in March. Corn was 570, well below that 607 already, because we were setting ourselves up for this downtrending market. And our date target was saying, hey, let's take some action. We priced again another 20% in April at 571. We weren't real happy about that because those are largely just at the top end of what we thought was our cost of production range. And again, one of our rules is we don't want to price pre-harvest below our cost of production. So those were kind of as low as we'd like to go. Well, all of a sudden we get through, end of April, and then all the way through May and into the first part of June, we were literally seeing futures prices below what we considered our cost of production. So we were not taking action. We missed a date target. So as soon as we hit that, we did a makeup sale on June 15th. We were able to get up there. We hit our date target again, but we were all now 2 months behind. So we did 30%. Prices kept going up. We thought, hey, maybe we can really get get a great price here. Started to turn down. And so we've priced our final increment, that last 30%, June 23rd at 588. So essentially we're sitting there. We have an average 577 CME Group December futures position. I'm looking over here at the chart. Right now, last time I see here, we're seeing 550. So all of these are profitable hedge positions and having us priced above our cost of production. The thing I want to do, though, is kind of take a look at, what if I used forward cash contracts at each one of those 4 times, right? March, April, and in June twice. If I was in Topeka, Kansas, where basis has been roughly new crop basis 30 cents under, when we had that last run up, it did weaken a little bit, that new crop bid. Our weighted average of those 4 forward contracts would be 547. In Salina, where basis is a little stronger, 15 cents under, we had a net weighted average of those 4 forward contracts would have been 561. And in Garden City, obviously, we receive a positive basis. We were at 604. And that's kind of compared to that state average break-even composite cost of production that we've been using of 550 per bushel. So again, if I'm pricing here using our plan, we've got everything we wanted to price pre-harvest done. On the forward contract side, I'm done. And we've did all this, except, Topeka is pretty close, but pretty much at or above our cost of production. So again, you look at the end of the day, as long as I just need to grow and deliver that crop, I'm going to be profitable and I can go on next year and survive. least on my corn. What if I use futures, right? If I had those 4 futures hedges, 570, 571, 575 there in June, and then that last one, June 23rd at 588. Well, and I did this as of yesterday. Those positions were up 35 cents at 570 corn, right? If you look at that one specifically, 570, it was up 35 cents. Right now it's 550, so we're still up 20. We would take that futures gain, we'd add it to whatever our harvest price is, and that's where we end up. Again, it's going to end up very close to what our forward cash contracts are. But right now, is if I had sold futures each of those times as opposed to forward contracting, I'd be up all those positions and I'd be feeling pretty good. I got a positive level in my brokerage account, and things are looking pretty good. The one thing we may want to think about is, okay, when do we close out these futures positions? Again, I'm positive. My positions are plus. We're in pretty good shape. And obviously, when we put these hedges on, the goal is you carry that futures position all the way to harvest. And I sure would think people should continue to do that. All right, let's pivot and take a look at soybeans. In that one, we were able to price in our 5 increments that we had. As you see, we were at April 14th, June 15th. We were always kind of towards the tail end because it was our date targets that were pushing us. Again, January 1, we were at 13.97. We got up above that for a little bit. And finally, look at soybeans now. We're at 14.12 last time I see. So we're well above all those prices now. So we're seeing a great rally in soybeans. But for the most part of this year, right, from January all the way through June, we were pretty much always below that initial price in January. And so our marketing plan and our date targets were driving us to take action. So basically 100% of what we wanted to put into our pre-harvest plan is done. If we use futures, then we would have had an average CME group November futures position of 13.24. As of yesterday, that was down 71 cents, right? Because we're seeing prices rally. But again, the point being, it's a hedge. So a negative balance in my futures account means my cash price is going up. And so I'm going to be in that same place, very similar to where I'd be on the forward contract. Now, again, I'm going to do the same thing here on soybeans as I did on the corn. If at each of those 5 times I would have did a forward cash contract, I'm essentially done, right? I'm done. And the weighted average of those 4 contracts would be a 12.72 price in Topeka, where basis has been 50 cents. I think, again, it weakened here this last run up we saw. Pretty much have been running 50 cents throughout the year. But again, as futures took off, we are seeing some of those new crop bids weaken relatively. And I've got that built in. But again, all of that was as of yesterday. Salina, where basis also was 50 cents, but it weakened this last time a little bit more. My weighted average price on those 4 forward contracts is 12.71. Fredonia, a 66-cent average basis, I'm sitting at 12.55. Now that would compare to my statewide composite break-even estimate of $12. So again, forward cash contract, 100% of everything I wanted to do. My date targets were kicking in, but I am 50 to 70 cents above my estimated cost of production. Again, all I need to do now is get that stuff growing, hang on for the rain, and get it delivered. But I should feel very good about where I stand with this pre-harvest marketing plan. All right, let's roll over and say I didn't want to use forward contracts. I wanted to use futures. Again, I had 5 separate futures positions, $13.99 up. $13.99 was at that time 4 cents up yesterday. That is down now. All of those positions are down. And again, the key thing though is what I'm down in the futures market, I'm going to be up on the cash market. So again, it's a hedge. Where I'm losing on futures, I'm gaining on cash. And so I'm going to end up pretty much where I thought, as long as basis stays where it is. 50 cents, 66 cents in Fredonia. I'm going to be very close to where I was before. But I'm hitting margin calls, right? On that 12.72, that third one I did, that's like a $6,000 margin call on a 5,000 bushel contract. So again, if I'd use forward contracts, I feel safe, I feel happy. I'm going to end up pretty much the same place as I would with futures, but boy, my futures, I'm a little bit more nervous. And here, it really drives home that point that we need to work with our bankers. We need to work with our brokers. We need to pay attention to where markets are going. And again, we need to be thinking, when do we close out these positions? And the bottom line is we want to carry this thing through until harvest. I would not advocate trying to lift these positions, especially at losses. The last crop we're looking at is wheat on the pre-harvest side. And I'm just going to start by saying, as everyone knows, the 2023 wheat crop in Kansas was a disaster. We had somebody on a call earlier this week, I guess yesterday morning, hadn't even started wheat harvest yet. So much green sucker heads were coming up and they were waiting on it to see if maybe there's going to be something to harvest. This has been a mess. And as again, you look, October 1, when we started that plan, futures were at 960. For much of the year, futures have been below, right? And as I look, let's see here, I think we continue to be below that. And it went off the board at 801, right? June 30, the CME July contract went off at 630. On June 30, it went off at 801, which if I'd have been lifting my hedges then, I would have had a $1.28 futures gain on my two positions, right? We sold roughly 27% October 10th of last year. We did another 20% in May of this year because we popped back up into our cost of production range. But again, for much of the year, we were below our estimates of cost of production, so we didn't take any action. And in a sense, we only got about, probably less than half the crop priced, and probably good. We should not have, because we didn't produce but half a crop. So that's kind of where we're at. That's all I'm going to talk about as far as this year's crop. But if we would have followed our plan like we did, you would have been closing those positions out in a pretty good position. Again, using those 2 times and the estimates of basis, I would be delivering on forward contracts of 919 on average. Hutch, if I was out in Hayes, it'd be 895, and in Garden City 888. So again, not too bad at prices. And for what we did, I feel like the plan worked. And so we very much encourage people to work with your county extension office and line up one of our workshops. I think they really do pay. When we talk about marketing plans, a marketing plan is really a proactive strategy to price your grain before, during, and after harvest. And so when we look at this year for wheat, we're just past June 1, it's July 19th. We're really in the time for our 2024 pre-harvest plan. It's time. And we are now in the post-harvest phase for the 2023 crop. And I kind of like to focus on the pre-harvest side. So let's take a look at pre-harvest. This, again, was as of about 9 o'clock today, the 2024 July futures contract. Again, I'm going to click over here, my futures chart. July is now trading at 831. So again, we're still below the contract highs, but we really are approaching contract highs. And so, we think about it. Do we want to be thinking about this new crop marketing plan? I would argue that it's too early for action, but definitely it's not too early to begin planning. And definitely a time to start assessing, and I'm sure many people are, what are your 2024 wheat crop costs shaping up to be? Now, before the drought hit, our 2023 composite cost of production was $8. Dan and I were kind of chit-chatting about that before we started today. Fertilizer costs are down somewhat. So we might see a situation, and we'll see. We need to wait and find out when K-State puts those out. That really our cost of production estimates are going to be pretty close to that, again, $8. And so we need to keep that in mind. We don't want to price at a price that would be below that, but this market is moving and attacking the new crop, or that crop highs. So we need to be thinking about this. It's not too early to be thinking about that 2024 marketing plan. And one part of that is how many bushels will you include in your pre-harvest plan. In our workshops, we spend a fair amount of time talking about how many bushels should we put in there. Should it be a percentage of your expected production? Should it be a percentage of your APH? Maybe better yet, because that way you've got insurance covering that. As we've seen in 2023, obviously this is very difficult, right? Dry land yields in Kansas are going to vary significantly. And that impacts not only your production, but also your minimum acceptable prices. And so it does make it difficult, but it doesn't mean we shouldn't do something. What marketing tools will you use? That's another key question you want to think about when we think about 2024. The amount of crop you store at harvest versus selling or delivering will impact your pre-harvest marketing alternatives. And the bottom line is, for the most part, for crops that you're going to put in the bin on farm, you really need to rely on marketing alternatives that don't require delivery, right? Because you can't deliver. Now, if for whatever portion of your crop you're going to be delivering at harvest to the elevator, to a feed yard, to wherever, then okay, we can look at things like forward cash contract bids and some of these things that would require delivery. And so that got me thinking, and I wanted to share, how much do we store on farm here in Kansas in general? Every farmer has their own plan of action. You know what you're planning on doing. But again, crops stored on farm, right, at harvest need to rely on marketing alternatives that don't require delivery. So that means, if you want to pre-harvest market that, you're looking at selling futures, you're looking at buying put options, you're looking at, some of these kinds of things you're going to put in there. So what percent it is? Here's what I kind of looked at. I looked at NASS data, stocks data, before and after harvest for all these crops, corn, soybeans, wheat, and grain sorghum. And it's kind of interesting. This is a rough estimate. I'm not saying this is hard and fast, but it's kind of a quick look. Obviously, I think as most people know, we store a lot more of our crop on farm corn. Soybeans follows at 30%, but 41%, again, of our corn usually goes on the farm. Grain sorghum, much less. Wheat, much less. But I guess the bottom line here is that, when we start creating this wheat plan, really a lot of our expected production can use some of these tools that would allow us to do delivery, right? Because we're not going to store it on the farm. Forward cash contracts work better for wheat than maybe it does for corn, because 50-60% of your corn is going to go on farm, and obviously we don't want to use any kind of a thing that's going to use call for delivery. So with that, I'll be checking for questions and things like that, but I'm ready to turn this thing over to Dan. Again, I want to thank Rich. I want to thank Dan for the opportunity to visit with y'all.
Thank you all. I really appreciate your interest in being a part of this. It's just a really critical time in the grain markets. Here we're in mid-July. In a number of years, if we were under consensus good conditions for corn and soybeans, probably the majority of years would have already started to decline and head off lower into harvest. But that we haven't is indicative of the uncertainty and questions that are out there. And in a normal year with the wheat harvest in, if we'd have a large crop and we're tight worldwide, we'd be seeing harvest lows. And if anything now, with this issue of not just our own issues in terms of the U.S. crop, but also this international issue of Russia, Ukraine coming in and affecting things. You've got today a run up of, at least so far in the day, 35-40 cents, and just interesting to watch. So we'll try to address some of those things today, give you as objective and judicious a set of information as we can to help you on your decisions. The drought monitor surely shows the dryness of conditions. It's the latest one that I can get hold of, and you see through the very heart of the U.S. Corn Belt, the dry conditions, eastern Nebraska, pretty dry, not as extreme overall, but in Iowa and Illinois, most of Indiana, southern Wisconsin, southern Minnesota. Note some dryness creeping in into the Dakotas, western Kansas. Given where we were in the past, we're generally feeling pretty positive concerning the rains that have come, but still, a drought monitor measures soil moisture in the depth of the profile, my understanding. So you can still get pretty good yields in a year where the drought monitor shows problems. And Iowa has done this the last 1 or 2 years. where they had rains that kept coming, fed the topsoil, and got some good yields. So you can beat a bad drought monitor situation if you keep having moisture come into the topsoil. Let's see if that's been happening. So here you've got North American precipitation versus normal the last 7 days. So it does look like in the last few days that Iowa, northern Illinois anyway, some of the areas that we're talking about did catch some moisture, other parts not. You see northern Missouri, parts of Illinois, Indiana, etc. Note the dryness. A lot of concern in the wheat market, I think, coming down from the dry conditions generally up in Canada, now affecting those northern states. This is the last 30 days precipitation of normal, and again, you do see that Dakota information. Overall, we've caught some moisture. If you read the thoughts of market watchers at this time, a lot of what's driving strength in corn right now is concern about hot, dry conditions in the next 1 or 2 weeks. Of course, we're in July. We've tasseled. We're in a very important reproductive time period for corn. So hence we've got support for that. Soybeans, more of that vulnerable time comes in several weeks, a couple weeks now, off into August. But right now it's corn's time. We've got hot temperatures, and hence we have support. And you look at internationally, you can see again dry conditions up into the Canada, South America. You still see dry conditions in Argentina. You do see some challenge, some varying dry conditions, but not overall a mass of dryness up into Brazil. Generally, it's thought that as we transition from La Nina to an El Nino year, that southern Brazil would get moisture, northern Brazil be more at risk to be dry. We'll see. Note also, you look into Europe, you see that dryness up in France, Germany, et cetera. You do see reports now of concerns about wheat crops and some of the crops in those areas. Generally, interesting that some of the same areas that you kind of year after year, the last 1 or 2 years anyway, tend to be dry in India and parts of China, and a lot of concern about what may happen with El Nino coming on in Australia. Don't see a lot of problems yet, particularly in the eastern part of the country where a lot of crops are grown. So I guess we'll stay watching. Feed grain markets. Mark, as you were talking about forward bids, interesting to look at what the harvest bids are and the variability around the state. Now, when I go and look at these bids, I pull them off of DTN, basically by zip code around these areas. So these are the very highest bids that are available. Garden City, positive 30-cent bid for new crop corn, positive 90 for cash. But note, Columbus has just about as high a cash bid as in Southeast corner as Garden City does, and some other generally positive bids around. So would also say we are watching grain sorghum bids, and again cash bids generally positive. Note in Salina, pretty positive, the most positive new crop bid for sorghum there. And of course that's an export center. It would make a lot of sense that they'd see positive bids there for that. So you stand back and try to get a gauge on and a perspective on the markets. So here's the lead contract as of yesterday's closes. Of course, this is now if things maintain 10, 15 cents low, but in general, we've been downtrending, and the run up that we've seen of late is off of lows around 480, 475, something like that. So we're now moving up to about 550. We had been just as you'd shown earlier, we were first of the year, we saw cash bids that were quite strong. 688 and 3/4 got to the high side. This is overall U.S. overall corn, and have generally went sideways to lower, and now are coming back off of those lows. So, so much of whether we're optimistic or not about the markets depends on our frame of reference. What's the reference price? Right now, we're pretty optimistic, considering we were just below $5 down to about 4.80. We're not yet back to where we had been earlier. We'd also note, you can see it here for I think this is September corn. Let's see, is that right? I got a deal in the way there. I can't see. Is that you'll have to help me. I can't tell which chart that is because of something being covered up. But anyway,
yes, it's December 23 corn.
It's these. Thank you very much. Thought I had new crop. So we had been there. You can see the high that we jumped up to about 630 thereabouts, fell down to 480 as a low, and now we're back up to 530, 534 and a half. Or that was yesterday's close, and then we're X 10, 15 cents above that now. So we're definitely better off than we were about within the last week and a half, but would have ways to go yet. So I think as you sit and view this, you're no doubt if you're a corn seller or a corn buyer, you're trying to judge what's the possibility of retracing higher back up towards $5.70, $6 thereabouts, and we'll talk about some of that. I would note that USDA World Ag Board makes price projections, and we at K-State take the prices that we have in hand and futures prices and project forward to see what our estimates would be of the marketing year average prices. Current marketing year average price, according to futures, about $6.50. That would be in this marketing year that'll end August 31st, not that far away. The new crop forward price has, with what's been happening lately, jumped up to about 542. And that's basically assuming pretty much even basis situation. The USD so what we've got right now is very much in line, almost spot on what the USDA's projection for this marketing year at 660. In fact, the futures just a little bit below that. The USDA price projections 480, good conservative number that they've had that since early on. With the recent run-ups that we've seen the last bit of time, futures have actually jumped up to above $5. You could argue back and forth on the basis assumptions. That's 525 or is that 542? But it does seem that we've had a kind of enough of a change in outlook, or enough concern of the market that we're moderate, at least moderately higher for the price outlook for corn for the coming market year. That last USDA report had followed, of course, that was released July 12th. On June 30th, we get acreage number, and you can see if you can see my cursor moving, the changes that happened since the June report, up 2 million acres, 2.1 million acres for corn planted, harvested up 2.2, up 5.5 to 7 from the previous year. So strong move. The USDA did ratchet down its projection to 177.5 bushels per acre, down 4 from where it was at 181.5. The early one was a trend line yield. They've seen evidence of some of this, some crop concerns, and move that back to 177.5. And note, so by the time you raise the acres, drop the yield, you end up at just about the same place in terms of about a 15.3 billion bushel corn crop. And I think the big issue is that with these acres, you'll have to have a pretty staunch drop in corn yields to end up with the ending stocks falling below 2 billion bushels. You could get down to 176, 175, et cetera. It's going to, you'll end up, and eventually you do get down to 2 billion, move to about 1.8 if you drop enough, but you have to have, in essence, a tremendous drop, in essence, about 6 or 7 bushels an acre for U.S. average yields to get down below that. So that's something to keep in mind in terms of your what you think about where corn prices could go. So overall, it'll take a lot at the end of all this to move us to move us to 525 or 550. We'll have to prove once we get out to those August and September reports that we actually have problems. Note, you can see that. So my own estimate, here's the USDA's estimate. That was as of July 1 here with more information since July 1. It was made on July the 12th, but things have been changing since then. So my own conservative estimate, I'm thinking more along the lines of 175.5 instead of 177. But again, I wouldn't say it's unfair, but the USDA comes in and they look at everything on July 1. Well, there's more information. So we'll see what they do on August 1st. And by the time they do that August report, they'll have farmer surveys in, there'll be more information to take in. They won't. And I know Doug Bounds is on this. So, and correct me if I'm wrong, they don't have enumerators going out into the field in August. That happens in September along with farmer survey. So we'll see, but I'm more inclined to think of something less than the 177.5 as to where the USDA will go. So go ahead and try to put down my own reasoning on where I think the markets will go. So if you plug in that 177.5 same acres and excuse me, if you plug in the same planted acres and 175.5, 2 bushels per acre off, you're still above 15 billion bushels, down to 15.15 thereabouts. And you end up, if you follow, and so you're kind of going back and forth between the USDA projection 177.5, K-State number, at least in my mind, of 175. Of course, I weight 60%, more likely to think 60% chance of the K-State one happening, 20% on the USDA one, but that's only because there's been more weather challenge since that time. But note, by the time you run through that, you're still above 2 billion bushels ending stocks. And so for me, I don't see ultimately a lot of change in price. That's surprising. I know the futures are talking 542. So the futures, at the time I go through our models, et cetera, you'll note over here, the futures are thinking closer right now. They're bidding closer to about 173.5, or basically just below 15 billion bushels. So I guess this will be the debate that the market will have as it goes forward. Right now, I'm still pretty conservative. And Mark, for your forward pricing issues, I think if you ask me, should you hold on to hedges? I still think we're going to go a long ways to really cut stocks down low. And I think at the end of it all, we'll still end up with something around 510 thereabouts for prices. That's just my own thought. We'd have to lose basically 4 bushels an acre and get below 15 billion bushels in this supply demand environment to really see prices move to 550 or higher. And I guess I already talked about that here. You can see it graphically, the change in percent stocks to use and the adjustment in price. There's the USDA number, and you can see that how things would change. So maybe by the time you look at 173 or much lower, get down to 12%, I'm only putting about a 5% chance of really getting down to 170 bushels an acre. We have and such getting to $6 a bushel. So that's you'll look at this, it seems pretty conservative. And if you talk about the soybean situation, that's a lot different. So I wanted to show you the relatively conservative corn one first. Just take note, ending stocks. When you see that red bar for the 2023-24 marketing year, keep in mind that includes the coming year for South America, and that crop hasn't been planted yet. They plant that September, October, November, and into December on the latter part. So that's next year. So we're projecting normal production, South America, no problems, and with that, then we start to rebuild stocks. but the market year that we're in is just awfully tight at about 10.5% stocks to use, excuse me. And that's the world less China number. And so again, the thing to keep in mind is that these market year, when they come out here in August, September, when they talk about 23, 24, they've got an assumption of normal crop production, large crop, no hiccups in South America. And with that, then yes, we start to rebuild stocks. I did want to show you for Argentina, so you can see on the specific numbers, Argentina anticipates recovery from a drought. Brazil anticipates some cutback. So I guess I'd encourage you to think about the situation down in Brazil. They're seeing very high soybean prices. They're seeing okay corn prices. Soybeans take less crop inputs generally than corn. So if we're focused on where we'll be at this harvest, that's one thing. But if you're looking out into the next year, into 2024, where we're at, probably see a whole bunch of soy. I would think, let me use this more scientific term, probably see a sharp increase in Brazilian soybeans, and unless we have really good yields, this situation in Brazil probably in question. You could see a lower number. So that'll be my own thoughts as we go through this winter. I guess a question I'd have: where will we be? It would seem to me that South America is probably going to swing pretty hard to soybeans, and especially if our crop is short at all, which we've cut back acres. So you've got this: once you drop with our reduced acres, the next you drop with their increased planting down the road, and then where do we end up in 2024? Probably with if we have normal yields, strong increased supplies in soybeans, decreased supplies for corn, and kind of a reversal of where we're at now in terms of these two crops. Well, these two crop. Take back that last statement before I say there's a reversal. And Ukraine, look at the drop anticipated. These are USDA numbers, which are relatively conservative. You can see that the 30-40% estimate, lower production, exports starting to drop off. So you would think this would impact U.S. corn exports, but we really haven't seen that happen yet. We shall see. But without doubt, problems in Ukraine are affecting their productive capacity, much less all the trade flow issues that they're dealing with. And for sorghum, note the 664 current marketing year price, corn number just about straight on even with corn, the way we're figuring it. And again, it's just a carbon copy in terms of the 542 projected price now for this new crop marketing year. The USDA's projection of 480, and again, I'm generally more conservative than those. But note what has happened coming out of that June report for grain sorghum, that we did see an acreage increase about just almost 480 million acres increase. Not surprising if you're in Kansas to see what happened with wheat, with moisture come and crops planted. I wouldn't be surprised who would be surprised if that number ended up being higher, given what people were doing as they were trying to survive and maximize income on the farm in western Kansas and central Kansas. We'll see, but an increase in acres, and we'll see where all that goes. Let's talk about soybeans. So you've got corn and soybeans this year really are key commodities in terms, and as they trade acres back and forth, and as we start to see what the potential impact of crop problems are. Here yet this year, you see the spot prices all over 14, a $15 bit, even money with futures. That was as of very early this morning, 15.12 in Southeast Kansas. Southeast Kansas getting to be, if it wasn't a strong market, it's it's holding its own against almost any place else in the state right now. New crop bids, take note for soybeans that we have a lot of variation. New crop bid in Topeka 49 under. And that's the strongest bid. You've got some wider bids, but 90, 95, 91, 95 on Western Kansas. If you go into the east, the stronger Topeka number, Salina, Hutchinson, and Columbus all end up. And it's too late to plant anything, but it's interesting to see where we stand right now for new crop corn versus soybean ratios. Again, we're not going to plant anything anymore, but right now, 2.4, 2.5, that's that bottom line. Excuse me, over 2.5, 2.6 in the eastern 2/3 of the state. Still favoring corn in Garden City, more of a break-even situation in Colby. So corn versus beans and what the market's calling for, it's kind of signaled by these price ratios. So just interesting to see soybean price trends. You can see that, again, very similar to corn. We had highs 15.55 thereabouts for lead contract, fell off on spikes lower. These are weekly numbers, down to about 12.50, or now about $1, almost $1.50 higher than that, 13.95. And given what's happened today, probably a full $1.50 or more over that. And so the dry conditions and lower acreage starting to affect this. Still would have a way to go to get back up to where we were even in March and April, but we are moving to the higher side, and it's July. Take note here, I believe Mark, you'll have to help me again, Mark or Rich. I believe this is November, isn't it?
Yes, it is.
Yeah,
November.
Thank you. What a range, had gotten down in late May, basically late May, very early June, at one time down to 11.50, and are now trading around 14.25 thereabouts and or higher. So the point is, I think for new crop November, we're getting back up almost to our historic highs, to where we had been. And I believe if I go back and look at D's corn, we could look at that too. But anyway, surely a strong uptrend, has the attention of the market. Where's this thing heading? The new crop bids. This is probably where the USDA's conservative projection for the next marketing year and the futures at this time, given that run up you just saw, where they vary the most. So here you have the current marketing year, again, ending August 31st, almost over, all intents and purposes, 14.24 according to the futures cash bids. New crop bid 13.88. Things have changed since the USDA had projected that 12.40, and the 12.40 is up 30 cents from in July. It was up 30 cents from June. So I guess well, I shouldn't say things have changed. Expectations have changed. Where we'll finally end up, that'll be the issue. A lot of it has to do with yield expectations. And take note. So there on corn, we saw an increase of 2 million acres from previous numbers, down 4 for soybeans. It's kept the same 52 bushel per acre number as the U.S. yield. Projections just on the acreage drop, 4.3 billion bushels, down 210 million from where we were, end up with a 300 million in stocks. And you can see the stocks use ratio of 7. There's that 12.40. So there's your challenge when you go from a 5.9% stocks to use to 7. Do you drop prices from 14.20 to 12.40? So I guess this will be a real challenge, I think, for the World Ag Board to wrestle with this critter given especially what's happened in futures. Do they have their own mind on stocks to use issues and where a model will take them, or do they watch the futures? The futures have gone strongly optimistic on this deal. And excuse me. And here you can see, and really the question does ride with what will the yields be in. And really before August, you're pretty loath to make many changes. Rains could take you right back to expectations of 52, but the rains aren't here yet. 50 and a half bushels per acre, 49. You can see the numbers I put on that. KSU estimate, probably say there's an over about a 55% chance. This is the model, and Dan reasoning, thinking that it looks like, would not be surprised that eventually that number, that USDA number, probably be lowered. So I say 50 and a half, it's basically a 50-51 somewhere in there, and the chance that we drop 3 bushels an acre. Soybeans hang in there pretty well, really yield wise, but there is that opportunity there. And you see the scenarios put together they're based on the USDA, at least a 40% chance the USDA's right. And we end up there, we get the rains, no problem. Another 40% chance that, you know what, it's given what's going on, that we're somewhat lower than that, about 50 and a half. You can see that the difference in production is about 124 million bushels, and you end up going from 300%, 300 bushels, 300 million bushels empty stocks down to 261 stocks to use, about 6.2. And when I plug that into model and look price directions, you're at about 1365, and that's not far off of what the futures markets are currently talking about. And then you got these other scenarios out there so I had used that 50 and a half and rationed usage back. If we have the same usage, same strength of use, then you're getting down to 4%. If you get lower yields yet, 49, you get down to 3.3% stocks to use, and then you're at 15 to 17 dollars a bushel. But I only put at this time about a cumulative about 20% chance of that happening. So right now you hang in there objectively, you think, well, we're probably 52 to 50 and a half, something like that. With 50 and a half with some rationing, if we have demand holds up and yields are as they are, then yields go lower, then you're markedly higher. And so here's the current projection dropping to 1240. Here's USDA number, here's KSU numbers with lower yields and some aspects of rationing, and we're moving to the high side. But you don't get above this 1420 we had this year until you get out into that last 20%. And in fairness, you can't answer this question until you get into August and see what you have. The risk is there, but in essence, of putting 1 in 5, you end up with this type of situation. And note again, same situation. As you look to next year, that's next year's soybean crop in the red. If what we had this year is a 10-year low in stocks use, tight as we've been for a good while. So we'll be in a weather market this fall. It won't be our weather; it'll be South American weather. But we'll be watching planting for that crop and seeing where things go. Lots riding on that. It's really the difference between $12, $11, $12 soybeans and $14, $15. So we'll be just continue to ping pong back and forth between North America and South America in terms of supplies and where this market goes. And Argentina, they're anticipating an increase in production. You can see that in this figure here. They had a drought this year, sharp decline down 25 million. They're plugging in that they're going to get right back online. There's Brazil, their expectation, they're going to go to new record highs yet. So that's what the world is kind of banking on. And that happens, then where would that leave us for U.S. soy producers in the markets they're facing? If it happens, good, probably lower markets, but it hasn't happened yet. Those crops aren't even planted. South America overall, you add those together, and yeah, shooting to the high side. Stocks growing. China pretty much sideways, domestic crush, moving a little bit higher. Stocks a little bit upwards. So China's main buyer. Excuse me here. Okay. Let's go to wheat. So finish up. Here we got about 9 minutes. You can see wheat prices. Note the variation by the way, can you still hear mine? Good. I had a note on mine that I had an unstable connection, but I think we're going okay. New crop bids, Mark, as you were talking about, note that bid in Salina, 818, even money. Everything else 25 to 65 under. So where's an area of the state that's export oriented? And again, a little bit south of there, had some crop problems. Well, you're right there in north central Kansas, and putting out a bid that's indicating that they're looking for wheat, trying to encourage production for next year, and pretty strong cash bids in Salina and Hutchinson. Again, that central corridor, not and fairly strong also in Topeka. So, and these are harvest. Well, right now the post-harvest bid in Salina, because I believe they're mostly cut in that part of the state. Note the downward trend in soybean prices. Wheat prices, hardware.
Hey, Dan, I'm going to break in a little bit. Sorry.
Yeah.
You've gotten a little jerky on your internet connection. Why don't you shut your video off?
Okay, we'll do that. Let's see here real quick. Yeah, I did get that note too. It looked like they said I had an unstable connection. With that in mind, let's go and get this done quick before anything else happens. So here's downward, really sideways to lower trend for wheat. And again, you can see the September contract, I believe. We're just kind of trading we're almost dead in the middle of the range. You look at the RSI, the relative strength index, we're basically right in the middle of that too. So we are pretty much sideways, and we're in the midst of harvest. So that's not too bad as a position to be in. Note that the USDA's projection, current marketing year 883, pretty close to what the futures are saying. Of course, the marketing year's done. Heading off into next year, the USDA projecting 750, the futures thinking 824, and that number is probably 30 cents higher today. So we know what our supply situation is. This demand issue is being affected by what's happening in Ukraine. It's a big thing. So the markets are thinking much higher right now than the USDA's projection of 750, and the USDA actually had dropped that about 20 cents in the July report. And note yields 46.1 bushels per acre based on some late rains that helped winter wheat yields. Note the production had gone higher. Ending stocks, exports have been 725 historically. We used to say historically wheat, but recently that's sort of where we're at. And we've been struggling with exports. Ending stocks 592, nothing tremendous. Stocks to use 31.32, and 750 price down sharply from 883 last year. So to kind of finish up here, you've got a scenario together. Again, USDA's projection for this new crop 23-24 mark year, about a 40% chance they're right. I think the USDA has had trouble month after month keeping up with having enough U.S. wheat exports to actually keep up with its projection. So as it puts that 725 out there, you could put 700 million bushels in, you could 675. We're struggling in U.S. wheat exports. High currencies are part of it. You, with what's happening in Ukraine, will we eventually get more business in the US? Maybe so, but I'm wondering about that for about a year and a half. So it comes down to in essence, my own thought would be that where we stand right now, about they're probably who disagree with them on the production numbers. I would question the export figures, the U.S. export figures, and we'd still be closer to 710 thereabouts. That said, we have drought coming in south in the hard red spring areas, white wheat areas up to the north. You can see that U.S. wheat number decline, U.S. wheat overall decline, and still, even with reduced exports, you've got much higher prices, $960, if the drought from the north hits those other crops. Take note, you can see the stocks to use, low last year of 30.7, 31.9. If our friends from the Kansas wheat office are watching this, this is something that this is a concerning graph, in that ending stocks are moving to low side. It's raised the price of wheat. They would not question that, but that production has been ratcheting down, and we're tightening up on wheat to the degree that it makes domestic supplies harder to buy. Then you have this issue. So here's what basically the USDA projects 750. Here you can see on some numbers I've got that probably 750, 710 wouldn't be bad. So Mark, those forward bids are all, I think they're all better than, I believe they were better than where by my model wise, I think we'd end up at. So it's something to consider for next year. But note, 20% chance that drought comes in north, affects those crops, and we end up 890 to 960. Want to show you, just to finish up here, just some real areas of concern in wheat. So I just got done talking about pessimistic on our exports, but the world situation is it's just continues to get worse without us seeing in the U.S. a lot of export benefit from it. Note this most recent, this current marketing year, came out of July, projected to be a 16-year low stocks to use, 20% stocks to use, world less China. So tight as tight can be. Note the situation again, world less China stocks to use, 20%. Hasn't been that low since 2007, 2008. So tight, it's a conundrum. Tight and tightening world stocks to use, but yet U.S. wheat exports not really participating. Ukraine, you can see their drop off. Russia, where at this issue in Ukraine has taken about the third or fourth highest corn and wheat exporter and chopped their export business in half. So that's a factor in the tightening up of chop their production and export business down, and that's a factor as we go forward next several years until that situation gets dealt with. So you can see you'll have to help me. I have a hard time seeing what's up in that corner.
It's Canada wheat supply demand trends.
That number's in great. Last number, that's assuming normal weather, and this would be where as NAS would look at something, they're assuming normal weather going forth. There'll have to be a major change. That number's really in question right now for that last marketing year. Australia, they've already, because of El Nino, they're anticipating, even though their weather looks good, they've already chopped their projection down. And Argentina, European Union, again, you can see Argentina anticipates better weather again. European Union, not really showing a lot of change, although they have some dry conditions. So stand back and look at all that, and it's really, I guess, not to be over dramatic, but it's really a moment of decision in the grain market, I guess, as it always is, but especially now for corn and soybeans, anticipating dry weather the next 2 weeks, futures running up. You do have in the wheat markets, this situation with Ukraine, Russia, that I think, you know, when you see the markets jump around 35-40%, 30 cents a bushel, they're dealing with something that they were not well prepared to anticipate. So perhaps if it sinks in that Ukraine will not be able to get it out very, very readily, or through either land or sea, and the port of Odessa, we read this morning, it was attacked. There are issues there that'll affect its ability to ship grain, much less ensure cargoes coming in and out. You've got the wheat market jumping around. So I guess I'm not just trying to get over dramatic, but objectively speaking, you've got these factors in play now that are really bringing about uncertainty and questions in the market. And we'll see where we go in the next month. But as we stand right now, this is not an unvolatile environment. So with that, there we go.
Can you see the chat, Dan?
Okay, let's see. Let me get to that. 3 new messages. Okay, let's see. Would you consider what you consider to be the full cost of carry with $6 corn these days? Well, storage, commercial storage, and do you add interest on top of that? So if it's commercial, if we're looking at on a cash basis for corn, if it's $5, excuse me, five, is it 4 cents a bushel a month? Is it 5? Then you've got that. How do you handle interest as an opportunity cost? If you had interest on, you've got a cash cost of paying a commercial elevator. That if we're talking about commercial, if it were 10% interest, it'd be what would that be per month? It would be 6 cents. It's probably 3 cents, depending on what interest rates you're paying. So for on-farm, for commercial storage, if we'll be kind and say 4 cents a bushel a month, add 2 or 3 cents in opportunity cost interest. If you're looking at full economic cost, 7 cents, 8 cents a bushel. If on-farm storage, less upfront, although you have handling. Let's say you cut that in half for on-farm storage. It would be polite in terms of dealing with the cash cost of handling that. So let's say it's 3 cents, 2 or 3 cents, 2.5, plus the same 3 cents interest. You're looking at 5.5 to 6 cents per bushel. So Ward, is that would be how I would tend to approach that cost of corn. And if you're looking at old crop now, then do you keep? I assume you're probably talking about storing corn from last year. Do you continue to do it, or do you take opportunity? Well, we just talked about how volatile the environment is. It's getting to be more and more of a Las Vegas gamble, and to hold on to corn, particularly with which is really almost a surprise now that we've been given. Okay, let's see, just try other. Okay, let's see. I'm having trouble getting to the chat. Rich, you'll have to read me the other questions.
We really don't have anything else that I have.
Okay.
Unless you have something that was sent to you personally.
No.
There was a comment from Brady Huck on call options earlier, more with Mark stuff. And Doug did confirm that the objective yield measurements will start as of September 1st.
Yes. Okay. That's what we had understood. So.
Folks, if you have anything else, go ahead and pop it in here now. If not, we'll go ahead and call it a day and move on. We'll have one more of these on August 30th. So that'll be in about, 6 weeks? And so we'll figure on doing that.
Yeah. Just think of how many questions will probably still remain to be answered, but how much more information we're going to have by then. And if it remains dry for the next 2 weeks, then where does that put corn, and where do we stand then for soybeans? But hopefully our fears are overblown and we end up with good crops and are able to go forward.
All right, Dan, thanks. And Mark, thank you. Appreciate both of you doing this. And folks, we thank you for being on. I'll have the recording of this available later this afternoon, and I'll send an email when that's ready. So we'll catch you again next month on August 30th.
Thank you, folks.
Everybody.